In our chapter on risk and return, we introduced the idea of correlation, expected return, standard deviation, and beta. And so I thought it would be a good idea to, instead of just talk about those conceptually, to give you guys an idea what some actual correlations are, what some normal returns are from stocks over the last few years, what some standard deviations are for stocks over the last few years, and what some actual betas are. So what I did is I went from January 2007 to March 2012, give us about 5 years worth of data, and we looked at a few different companies. List of companies over here, we've got Deere, Caterpillar, Coca-Cola, Pepsi, Boston Beer, which are makers of Samuel Adams, figure a company that college students might be familiar with, Apple, Ford, Cabela's, JP Morgan, Bank of America, Chipotle. So I tried to pick a mix of companies that everybody was probably familiar with, recognize the names of these companies, and the S&P 500 down here at the bottom. That is just a measure of the overall market. The S&P 500 is an index. It's a portfolio of 500 larger companies, and so it's designed to measure how the market as a whole is moving, what's happening to stocks as a group. And so from these companies, I want to start by looking at some of the sample correlations. Remember, correlations can range from -1 to +1, but usually are going to be somewhere in between there. And when we talk about correlations for individual stocks, usually they're going to be a positive value from low positive to high positive value. Now these are estimated from monthly returns. And so if we look at companies in the same industry, one thing we'll notice is that they tend to have higher correlations. Remember, the highest possible correlation is 1. So if we look at these companies like Deere and Caterpillar, both making a lot of heavy equipment, they've got a correlation of 0.74. Coca-Cola and Pepsi, both in the soft drink industry, correlation of 0.69. JP Morgan, Chase, Bank of America, large financial institutions, large conglomerate type commercial banks, money center banks as they're sometimes called, and they have a correlation of 0.8. So whenever we see these companies that are in the same industry, we're typically going to see higher positive correlations. Next, I took a look at just a sample, and this isn't a list, detailed list, but a sample of some of the pairs of correlations or correlation across pairs of stocks, but now we're no longer in the same industry. So you have things like Deere, heavy manufacturing equipment, farm equipment, and Pepsi, a soft drink company. That gives us a correlation of 0.4. Deere and Boston Beer, 0.24. Deere and JP Morgan, 0.45. Deere and Cabela's, 0.22. As we get into these companies outside of the industry, we see they still have positive correlations, but now the correlations are lower. And if I look at the average across every pair in the sample, that gives us an average correlation of 0.37. So you can see, same industry, our correlations are up around 0.7 to 0.8. Outside of the industry, our correlations drop significantly, but they're still positive. And that's kind of that firm-specific versus market risk factors. A lot of the things that affect Deere as a firm are going to affect Caterpillar as a firm. Remember, firm-specific risk can accompany not just the individual firm, but also the industry. So these industry-related factors are going to tend to drive the correlations up for companies in the same industry. When we get down here and we're talking about firms in different industries, there's no overlap of firm-specific risk, so now we're just capturing that market risk factors, things that make the overall market go up. That's going to tend to lead to positive correlations across firms, but not anywhere near the maximum level of 1. Next, we look at how do individual firms move with the S&P 500. And here you can see not quite as high as firms in the same industry in general, but still pretty high. So when we look at average correlations for individual firms to the S&P 500, and we should note these tend to be larger firms, they're all actually part of the S&P 500, we tend to see a much higher correlation than individual firms to one another. So this just gives you kind of a baseline of what some normal correlations might be. If you're looking at any pair of stocks, you should expect to see a low positive correlation. If that pair of stocks is in the same industry, you should expect to see a higher correlation. And if you're comparing an individual stock to the market, typically you're going to see a higher correlation. Now, the next thing I wanted to look at was a table of average returns, standard deviations, correlation with the S&P 500, and the beta across the same firms in our sample. And one thing you can see is over the past five plus years, we've seen a wide range of returns. Apple has just knocked the ball out of the park, 45.66%. Chipotle right there with it at 45.14% average return. Some companies like Pepsi, JP Morgan, not done near as well. Bank of America has actually got a negative return over that time period. Now remember, these average returns are observed returns. They're not the expected return. We're not expecting Apple to continue to earn 45% or Samuel Adams to earn 23%, just like we're not expecting Bank of America to lose 25% a year. Nobody would buy a stock that they were expecting to lose money on. So this just gives you a range of some of the historical returns that we can see for individual stocks. And then I've also got the S&P 500 here below. Now, standard deviations, you can see, also are going to range quite a bit. If we look at companies like Ford, Cabela's, Bank of America, we can see very large standard deviations. This Ford standard deviation is just huge. If we look at a company like Pepsi or Coca-Cola, they're much smaller. The S&P 500, remember this is a market portfolio. Now, a couple of points I want to make here. Notice that most individual companies have a standard deviation that is noticeably higher than the S&P 500. The two exceptions to that are Coca-Cola and Pepsi, which both have standard deviations that are actually a little bit below the overall market. That's very rare because remember, these companies have firm-specific and market risk combined, and standard deviation measures total risk, so it's measuring that total combined factor. But what this is saying is that Coca-Cola and Pepsi have such little market risk and firm-specific risk that their total risk is actually less than the normal average market risk for an individual company. Very rare. Usually we see individual stocks have standard deviations that are greater than an overall market portfolio. So most individual stocks are going to have a standard deviation greater than the S&P 500. But the main point here is just to give you an idea. When you hear the stock has a standard deviation of 20%, is that high? Is it low? Well, in order to really get a feel, you need to know what's normal. So this gives you an idea. Looks like a normal standard deviation, probably somewhere in the 30 to 50% range. Got a few above that, a few below that. But if you're in the 50% plus standard deviation, you're talking a high risk stock for as far as measuring total risk. If you're in below 30%, you've got a pretty conservative stock as far as measuring market risk. The correlations, we've already talked about correlations with the S&P 500. Interesting, the lowest correlation on our list is Boston Beer, maker of Samuel Adams, and what that's telling us is that that stock is not very closely correlated to the overall market. Now, in a way, this isn't very surprising because remember, the market is capturing a lot of general economic factors. And Boston Beer is a beer company, obviously. And if you think about that, when times are good, it doesn't mean people are going to start drinking a lot more beer. And when times are bad, people are going to probably still drink as much beer. People drink beer when they're upset and drowning their sorrows. People drink beer when they're celebrating. So selling beer is not going to be very sensitive to general overall economic conditions. Beer is going to sell well in recessions. It's going to sell well in boom periods. So it's going to have a lower correlation to the market. On the other hand, when we see companies like Deere and Caterpillar, heavy equipment, farm manufacturers, when times are good, people are going to be expanding new construction. They're going to buy more Caterpillar products. Farmers are going to feel more flush with cash. They're going to buy some new tractors. Those kinds of companies are going to do well in strong economic environments. They're going to do very poorly in weak economic environments. So they're going to have a much higher correlation with the market. And then we get to our beta. Beta for the S&P 500 is 1. That's our average risk beta. And remember, our formula for beta is just the standard deviation of the stock times the correlation between the stock and the market divided by the standard deviation of the market. So when I want to calculate the beta, for instance, of Pepsi, all I'm doing is taking the 16.98 times 0.55 and then dividing by the standard deviation of the market, that 18.56. That gives me my beta of 0.51. Very low levels of market risk. Here we see Coca-Cola, Pepsi, and Boston Beer, all with betas well below 1. That's consistent with what we would expect for those companies. We would expect them to be lower levels of market risk. Deere and Caterpillar, high levels of market risk. Ford, high levels of market risk. Chipotle, about average with the overall market. So these betas kind of fit what we would expect about the company. Beta is a measure of market risk, and stocks that are going to be more economically sensitive are going to have higher levels of market risk. Stocks that are less economically sensitive are going to have less overall market risk. Again, main point of this video is just to give you an overview. Here's some examples of real life standard deviations, real life correlations, real life betas over the past 5 years or so.